Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Josh Young, the portfolio manager of Bison Interests, and they recently launched a newsletter, Bison Insights, and so they focus on natural gas and oil and many other things, and so I'm happy to be here with you today, Josh.
Great. Yeah. Thanks for having me. And like we were chatting offline, congratulations on it's almost no longer new, the role with VRIC.
Yes, and so we obviously focus on natural resources and especially in the mining sector and such. But just thinking about natural resources, right now we have uranium has caught a bid, many of the stocks. We've had gold catch a bid, silver catch a bid, copper, many of these natural resources. And so I'm happy to talk with you about oil and natural gas today. And so why do you think oil and natural gas are not moving along with the trend of other natural resources? What do you think are the forces at play here?
Yeah, I think it's a great question. And I think it's sort of a good audience and a good platform to talk about the relationship between what's happening right now with gold and some of the other precious metals and sort of what that may lead to from an oil and natural gas demand perspective. And so historically, when you look at big moves in gold like we've seen, and then subsequent moves in silver like we're seeing right now, along with gold as we're talking, generally it takes somewhere between a year to 18 months before those big moves in the precious metals translate over into significant price increases on the oil side. And people think about that as sort of technical analysis, but when you look at it, it actually makes a lot of fundamental sense. And it's one of the things I find most of my peers in the sort of oil macro sort of barrel counting world are missing, which is that these giant mine projects get restarted or get expanded when you have higher gold prices and higher silver and so on prices. And so it takes a little while for those to get kicked off, but when they get kicked off, you can end up with hundreds of thousands of barrels a day or more of incremental demand for these mining projects. And it's strange, you can look at some of these supply demand forecasts and they won't even have a line item for mining demand. So I think people are in for a little bit of a shock. They're not listening enough to VRIC and other channels or paying enough attention to what's coming. But I think there's some significant demand coming, but it maybe hasn't shown up quite as much as it will yet. And so that would be how I'd explain the lag for oil versus gold and silver.
Gotcha. And so recently I had a interview with Rick Rule, and he talked about the Canadian juniors being a very hated space, and he loves to go where the hate is. And I've been seeing some other folks post some charts on oil, looking what it looks like in this channel where it's going to break out at some point and such. And so right now it seems like the contrarian play. I mean, it doesn't seem like a lot of people are positioning there, at least retail investors and such. And so do you have any perspective there?
Sure. Yeah. So I think the smaller cap oil and gas companies in the US and Canada and internationally are all very cheap and all materially overlooked. I actually think that the Canadian ones are less relatively overlooked because of Rick Rule and others sort of focusing folks' attention on it. There's sort of this like funny thing where the observation and the commentary can affect the reality. And so I think the outsized performance of those small cap Canadians in that sort of 2020 to 2022 timeframe has caught people's attention and retained their attention maybe more than in the US or for some of these non-Canadian companies. At Bison, we have exposure to US and Canadian and international small caps, and we found the bigger driver is the size rather than sort of the specific jurisdiction. And each of these jurisdictions have their own sort of trade-offs and geopolitical risks and supply risks and pipeline risks and so on. So, very interesting, I think, on the small side. Generally, people are looking for larger names. They're looking for ETFs and indexes and so on. And so getting out of those or going into sort of the smaller size, I've found has been very promising in terms of finding significant value.
Okay. And so I was just looking at Berkshire Hathaway's holdings and just to see if Buffett and his team are still holding Occidental, and they still are. I mean, they have about a 27% stake in the company. And so, I mean, obviously, Warren Buffett, legendary investor, and we've talked about this some years ago, but typically, he knows. I mean, he knows what he's doing, and so I'm kind of wondering, do you have any perspective there in terms of what the genius is doing or whatnot?
Yeah, I mean, I think he saw a cheap stock, and I still think the initial thesis for him on buying Oxy stock was that it was a levered play on oil prices. It had some of the most financial leverage and operating leverage to higher oil prices among the larger liquid companies. I've been to the Berkshire annual meeting a couple of times, and when I went, and I listened carefully to what Buffett was saying, which it's sort of a little different to actually go in person and really sort of hear him versus just getting the news clips or sort of watching the video. And both times he talked about how if he was running 50 or $100 million, he would be investing in way smaller companies that were way cheaper, and he thought he could earn much higher returns. And so I think it's instructive that he's sitting there holding this large position in what's essentially the largest leveraged bet on higher oil prices. And I'm inspired by that to continue my search and continue my ownership of smaller oil and gas companies at even lower valuations that over time, in theory, should materially outperform versus companies like Occidental.
Yeah, and what really interested me as well was you were sharing Bison Interests recent performance on the in the stocks that you all have been picking and such. And so I do want to share that really quick because I've heard multiple times that we're in a stock picking environment. That the passive funds. I mean, obviously, you could park money in a ETF and make money, but typically you're going to outperform if you're able to pick stocks. And so I do want to share just the performance of this fund and such. And so could you speak to this?
Yeah, sure. And again, the spirit of sharing this was not as any sort of solicitation, and then also as a reminder that past performance may not be indicative. I think it's helpful to share the performance because it's really easy to get caught in one or two specific ideas that one shares that go up or down or whatever. And what we do at Bison is invest in a whole set of these mostly smaller cap, mostly producer oil and gas stocks. And the closest index to what we invest in is this S&P 600 energy, where there's this ETF PSCE. And I'm extremely bullish PSCE over, let's say, the medium to longer term. I think there will be a catch up where small cap stocks do way better than large caps, sort of similar to what you're seeing now in the gold mining stocks and some of these other commodity sectors. When you get into a bull market, the place where the highest returns are in the bull market are in the small caps. And so, I think there's sort of this challenge, which is how do you survive in a 10-year bear market like we've experienced since 2015 when we launched? And the challenge, I think, the solution to that is to find deep value in special situations like we've been doing. So again, the point of this isn't to go raise money off of it, it's to explain, hey, we see things a little differently. And even in a terrible bear market for small cap oil and gas stocks, there have been phenomenal opportunities. We've also made significant mistakes, right? If there was only our winners, our returns would have been way higher. But there are these opportunities from severe mispricings, and I think it'll be really exciting as this PSCE and some of these other sort of smaller cap indexes and some of the small cap stocks start to outperform as we get back into an oil bull market and a natural gas bull market. I think there's going to be some really exciting things that happen for this sector, and hopefully we continue to outperform, but there's no promises. And again, I think the one other reason this is relevant for this conversation is I think a baseline for having a view on a commodity or a sector is doing well within that sector. And I think it's sort of unfortunate there's so many folks that have opinions about these things and so few people. I mean, inherently, if there's an index most people are going to underperform. It's sort of the wisdom of crowds and sort of the, a random walk down Wall Street theory. Most people underperform. And so the reality is when you hear these views on oil or gas or equities or whatever, most people, those views are going to underperform. And I think having a performance benchmark as a starting point, it's hard to do a benchmark on people's opinions on podcasts, but this is a starting point. It's like, hey, you know something about these stocks in order to be able to outperform from them. It's a quantitative starting point. And we had this conversation with a few folks on sort of the fund side, and I thought you would find this interesting. I didn't know we were going to get to see this on screen, so thank you for showing it. And again, just full disclaimer, past performance may not be indicative, and this isn't. I'm not sharing this to ask for money from anyone.
Yeah, for sure. Yeah, it's totally my choice to share it, y'all. But I do think that it's important to understand, like even in the gold mining sector, you have solid companies that are small caps, small exploration companies and such. That are pretty solid, have good projects, and then you have what many in the gold industry would call the shit companies, right? And so you have to do your due diligence. And so when an investor is looking at a small cap oil company, what are some of the things that you're factoring in? I mean, you're obviously an expert in this field, but what are some things that you're factoring in whenever you're looking at a small cap company? Because some folks may think of like, okay, well, I'll just park money in the Exxons or the Chevrons, the big names and such. And so just want to get your perspective there.
Yeah, so why don't I take that second observation first, which is I think that the Chevrons and Exxons, what they did to get where they are now is not what I think will carry them forward. So you look at the original Standard Oil model of an integrated company with integrated fields that was the lowest cost refiner and the lowest cost midstream and the lowest cost barrels produced, all tied in with a really tight cost focus run by a guy who owned it. He owned, I don't remember if it was the majority of Standard Oil, but Rockefeller owned a lot of it. And so if you look at how far it's gone, where now there's this sort of managerial class that owns almost no stock, and they're either empire builders or they're focused on ESG nonsense or whatever, and you look at their performance, and their performance is okay, but if you look at how well they would have done if they kept their core assets and kept their costs way down, there's significant outperformance that they've sort of missed by sort of losing sight of their history. So why is that interesting? One, I think some of these larger oil and gas companies are almost uninvestable because of this sort of deviation in terms of governance and incentives and so on until they sort of get back to their core model. And then when I think about small companies, for us, it's always been about management teams and balance sheets. So, management that owns a lot of stock, that's aligned, balance sheets that are survivable even in a big economic downturn or cyclical downturn, and then assets that are able to generate a lot of cash flow at most points in the cycle. And again, I won't say that we always get all of that right. Sometimes we're gloriously wrong, and those sorts of mistakes, I think, are instructive reminders of being careful about each of these things, or sort of at least accepting the extra risk that comes from, giving on one of those three main criteria.
Yeah, got it. Yeah, thank you for sharing that.
We've got three of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on two outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
So I do want to pivot to a little bit more macro. You've been sharing about OPEC and their production output and such. And so I do want to share an article on that I found on Reuters here recently. And in this article, it shares that oil settles up after OPEC Plus opts for a modest output hike. And so just looking at this article, one thing that was key for me, it says the market had run ahead of itself in regard to this OPEC Plus increase. And today we're seeing the classic action of classic sell the rumor and buy the fact reaction. And so just want to get your perspective on OPEC and this decision with the amount of barrels that they decided to output.
Yeah, so I think if you looked at, it was interesting to see this because the market wasn't open when they did their announcement, but you could see the real-time views of many of the sort of most famous pundits. You could see a bunch of the investment banks responded, and almost everyone was extremely bearish in response to the OPEC announcement. And so if you want to see a really fun one-day case study, at least among the folks that didn't delete their tweets or their papers they put out right after the OPEC decision, you can see the preponderance of negative responses to OPEC on that Sunday, and then magically everyone says it was obvious on that Monday. And again, this is where I think it's relevant to share a track record, because a lot of this stuff is just complete nonsense, and the narratives that people have are in most cases just to try to make themselves look less wrong or less dumb. And so, again, not that I don't make mistakes, I make mistakes all the time, but this one was just such a classic. The bears were celebrating, the bulls were mostly sad. And so, look, like what's happening right now is that OPEC is increasing production into a weak market from a price perspective. And so that is scary for everyone. It's exciting for bears and it's scary for bulls. And what OPEC is doing is they're saying we're tracking inventories, which we think is the fundamental measure of truth. It's sort of they're using it as their compass for oversupplied versus undersupplied market. And in their measure, inventories are low, not high. And so they view their job with these supply increases or decreases as getting inventories to an average level. And they'll basically just increase their quotas as much as they can to either get them there or to just have unconstrained production among their members. So that's what they're saying. And again, it's uncomfortable in the short term as an oil bull, but it's extremely bullish as, one, some of the OPEC members actually don't produce as much as they're saying they should. They rename it from production quotas to allowable amounts to various other nomenclature, which again I think does OPEC no favors. But as that happens, the spare capacity measures that people use go down a lot when there are countries that are quote unquote like allowed to produce more, but they're not actually producing more. It raises the question, hey, if it's a cartel or a group that's sort of controlling each other's production and people are choosing to produce less, then maybe they just can't produce more. So that's part of it. And then part of it is there seem to be some differences in views on consumption right now and how much inventories are actually building or not. And so OPEC is weighing in a physical manner, and they're allowing the market to sort of work it out from a price perspective. And again, they just keep saying over and over again, if inventories rise to sort of normal levels, then we'll consider cutting production again. So that'll be a big test for them, I think, if they do that, if inventories do rise. But so far, the calamitous predictions, again, sort of taking that one-day case study of the Sunday doom and gloom to Monday, it was obvious. Again, not talking about that particular analyst that was quoted, just sort of the general set of folks across the whole spectrum of commenters, most of whom were making public comments on that Sunday or that Sunday night or whatever. If you look at the forecasts at the start of the year and the revisions since then, starting at the top from the EIA and the IEA, so the US government group, and then the sort of non-governmental organization that's funded by a bunch of Western countries, all the way down through the different investment banks and barrel counting consulting firms and papers and everything. All of them, or almost all of them, were extremely bearish for oil for this year, and they forecast enormous builds of inventories. And we just haven't seen the builds that were forecast. And what they've done is just rolled those forecasts forward back another 6 months, and saying, oh, hey, well, the things I thought were going to happen in March, they're going to happen in October or November. And maybe they will, and maybe they won't. And the one important thing I think for people to understand with that is there's this tendency for demand for oil to rise by about 1% or so a year, just through the nature of things. Similar to people sort of expect 2% inflation a year, just as sort of the nature of things, whether that's good or bad, I don't know. But there's sort of a similar trend over the last 40 years for oil demand to grow on its own, even without sort of a big economic boom, by about 1% a year. So the reason that matters so much in this context for the folks that were doomy about the first half of this year and frankly were very bearish for last year and so on, as you roll back your forecasts, even if you end up being right about supply, every 6 months buys the oil bulls another 500 to 750,000 barrels per day of sort of quasi-permanent demand that's increased just by the nature of the world and the oil market. And so it's one of those things where the further back it goes, the more bullish it is, and the more the bears need to sort of inflate these supply growth estimates in order to have sort of scary sounding forecasts. So that's how I see it right now. And again, so far, the forecasts have been bearish. They've mostly been wrong. OPEC has added way more barrels, at least from a quota perspective, to the market than anyone thought they would, including me. And inventories are just not showing it so far. So, we'll see by the end of this year what's happened. But I think there's a very good chance, given what's happened so far, that we are having a similar conversation in December or January as we're having right now in terms of everyone having these calamitous bearish forecasts for next year. But the bearish picture didn't quite pan out how people were thinking for the second half of this year.
Yeah, and just staying on this kind of global, since OPEC is kind of a global perspective and topic. So there was talk about Trump and sanctions on Russian oil or whatnot. I mean, there was the issue with the Indian president and such, and president of India or whatnot, prime minister, whatever title it is, buying Russian oil and the potential of sanctions there. And sometimes, like I view those things as like temporary bumps. I mean, we've seen multiple. I mean, even in the gold market, I mean, you get this headline news and then you get like a bump up. Whether that's like a global conflict or something, but it's not really sustainable whenever you. And then when you get into like the tailwinds for gold, such as like the supply and demand for oil, you begin to be anchored into like your viewpoint on why you're bullish on the asset and such, and not just based off these headlines. But do you have any insight or perspective on the sanctions with Russian oil? I mean, you can't really tell whose name is on the oil, right? Or is it on the barrel or what? Like.
Yeah. So sanctions is a very weirdly politicized and weirdly controversial topic. I actually think it's really simple, and it's actually part of why I'm so bullish on oil here. So the U.S. President, Donald Trump, promised as a part of his campaign promises that he was going to strictly enforce sanctions on Venezuela and on Iran. And he promised to sort of settle this Ukraine-Russia conflict. So if you look at these claims about maximum pressure and sanctions enforcement on Venezuela, which has now had their sanctions actually essentially waived, with Chevron having permission to produce oil from Venezuela and sell it in the US, so full essentially waiver of those sanctions. And then Iran, where the Trump administration has repeatedly threatened to enforce quote unquote maximum pressure, but has failed to do so, has sort of continued to repeatedly threaten this and claim they're doing it, but also talk about how they've waived the sanctions too. So they've mostly, if you look at the Iranian barrels, they're basically on the market. Venezuelan barrels are also mostly on the market right now. You're looking at roughly 2 million barrels a day already of sort of extra production on the market, on the global market, versus what the sort of baseline would have been if you just took the policymakers at their face. So there's already sort of this weird sort of left tail event, which is, it's not so surprising for a politician to lie, but, the extreme to which they've gone in terms of waiving and ignoring these sanctions on these two countries where it's a very clear. There are laws about these sanctions. They're fully endorsed by Congress. They're fully sort of within the presidential powers, and then they'll intermittently sort of enforce them very slightly on particular people, I guess, that either aren't paying the right bribes or they're out of the favor with whatever. So they'll pick on an individual group, but the general thing, they're not enforcing those. So that gets to Russia, right, where it's way more complicated. It's really simple, in my view, on Iran and Venezuela. These are our enemies. They're funding our enemies internationally. Iran funds folks that try to blow up stuff here in the US and our other sort of ally countries. So that part to me seems very clear. Russia's really complicated because I think we've decided that we can't enforce sanctions on Russian oil. Even the Biden administration decided this, and they were sort of more, I guess, pro-Ukraine than the Trump administration has been or has signaled so far. And they decided they couldn't sanction Russian oil fully. They couldn't try to block it because it would break the world economy. There's just too much need for these millions of barrels a day of oil from Russia. So there's a lot of talk around it, but again, you sort of have this baseline, which is the decision by the US and Europe has been to have a price cap on Russian oil rather than sanctions. So they'll still talk about sanctions, but there's not, I think, a real reasonable expectation of full sanctions enforcement. And so the other aspect of this that I think is really interesting and worth people thinking about is that when you conflate these things and you promise to enforce sanctions and then choose not to on places where you're actually able to enforce those sanctions. Like there's a lot of evidence the US could enforce sanctions on Iran because when we did in 2018 and 2019, their oil exports fell a lot and the threats that we implemented were successful. So when we threaten sanctions on Russia, for example, or promise sanctions on Iran and Venezuela and then waive them, you end up with this big narrative of, oh, sanctions don't work. But it's sort of a silly thing because, of course, they work. We have evidence that they've worked. We just need them to actually be enforced. And the last note on that is Ukraine apparently has decided that they will enforce, and some of their social media accounts have been talking about this, they will enforce sanctions of a different variety, which is to go bomb the Russian refineries and oil pipelines and so on. And those are impacting the oil market. It looks like by a few 100,000 barrels a day right now, and they're impacting the global refining market. And again, that whole situation is terrible. Russia invaded Ukraine, terrible humanitarian tragedy, but just looking at the oil market, this form of sanctions on Russia, which is Ukraine bombing Russian oil facilities, does appear to be effective and is starting to pull Russian oil off the market. And it just started in the last month and a half or so, these sort of more direct and severe attacks on Russian infrastructure. If they continue, there's a risk that significant Russian oil will come off the market. But again, this is kinetic sanctions. It's not, economic or sort of political sanctions. So I would, again, categorize Venezuela and Iran as political and economic that we're choosing not to enforce, and then Russian where we've decided we can't ever enforce them, and we have a different mechanism that we've sort of not really done and hasn't really worked, and then Ukraine is implementing sort of a kinetic sanction via attacking Russia's oil infrastructure.
Okay. Yeah. Thanks for clarifying and sharing that. Cause it's definitely a lot to process. I mean, oil is a global, need for energy. I mean, energy being connected to life, but then it's so political and so many different factors. It's as an investor, you want to understand some of those and what's kind of driving the markets. I do want to get your perspective on, the recent job number revision. And so I'm kind of processing this. I mean, the numbers just came out today. I mean, 900,000 jobs. I mean, especially under Biden's administration, you had Jerome Powell saying that the job market was strong. And then even as Trump came in, and said that there's a booming economy and, fired the BLS director or whatnot for some of the data that they were gathering or whatnot. And so to revise 900,000 jobs, and it makes me think about multiple people that I've interviewed over the last couple of years were concerned about recession. And there was multiple indicators going off and such. And then just to see this huge revision in jobs, and thinking about how oil typically performs in recession. People don't go to work, then the demand typically dampens or whatnot. And so just and thinking about the oil price, like over the 2021 to 2022, like many of these stocks were doing extremely well. And then you had a big sell-off. And so just wanted to know if you got any perspective there in terms of these revisions. Like, were we in a recession or what? How are you processing that?
So first of all, I want to compliment you on the construction of that question. So I've noticed that I was telling you, I think off camera, I've been listening to a number of your other interviews, and I think you do a good job of sort of eliciting complex and comprehensive responses. And I think it has to do with the way that you're sort of framing this. So it's great. Like, you got me thinking as you connected these employment numbers to the politics and then to the oil price. And I think that's a sort of good trajectory. And I think it's worth addressing. So starting with the labor numbers, yeah, I mean, it's sort of weird, because when I would talk about how the labor numbers were clearly wrong 2 years ago, people accused me of being a far right political pundit, masquerading as an oil analyst and fund manager. And then now, when I push back on the numbers that the Trump administration is putting out, I get accused of being a far left political pundit and oil fund manager. I don't think there are any of those, but at least on the oil side that I'm aware of. But it's very, very weird and politicized and unfortunate, right? So the reality is that we've been, as far as I can tell, in a rolling recession since, let's say, early 2022. And the energy crisis that we saw predominantly in Europe, but also in the U.S. And parts of Asia have triggered sort of recessionary impulses in different parts of the U.S. and global economies. You had very big movements in energy prices in both directions. And just jumping to the oil part for a second, you've already had a 50% plus price move from the top of the oil price in 2022 to the bottom of the oil price. I think even by very early 23, you were down in the 50s or so. So you had a greater than 50%, I think it might have been closer to 60% top to bottom move, which is similar to what you saw in the extreme in, let's say, the 1970s bull market for oil, where oil went up a whole lot from the late 60s to 73, and then you had a big pullback into that very deep, very painful recession. So we've already seen this big sell-off in oil, and we've seen extremely weak demand numbers for oil for years now, since that sort of early 2022 timeframe. And so I think the right way to think about it is that the numbers were fake, unfortunately. It seems like, unfortunately, they're bipartisan and fake, so hopefully no one gets too mad. I'm sure both sides will have been triggered by what I said, so hey, have at it. I think the numbers are fake, sadly. The economy has been tough. There's been different narratives around it for why that's the case. You've had layoffs in various different sectors. You had tech sector layoffs in 2022. You had oil sector layoffs in 23, and then also now in 2025, you're seeing significant layoffs in the oil and gas by large oil and gas companies, both on services and upstream sides. You've seen layoffs in various other parts of the economy. You're seeing huge numbers of government workers finally getting fired, which frankly, that part's probably good longer term, but it's still very painful for those affected and, in the short term in terms of the overall job numbers. And so, yes, we're in a probably rolling recessions, just through different sort of parts of the economy. I think the positive part is, one, if they're lying about the labor numbers, they're probably also lying about other statistics. It's like Warren Buffett, you mentioned earlier. He has this cockroach theory. If a company is lying on one thing, you catch them on something, they're probably lying about something else. It's almost unbelievable that the government would be lying in its job data and have to do these giant revisions and not be lying, for example, in their gasoline demand data, where we saw, there was actually some Reuters analysis, they're particularly brilliant, where they saw that it was something like 80% of the weekly estimates of gasoline demand numbers had to be revised up in the monthly sort of more accurate measured reports from the EIA. So, I mean, there's your evidence on the oil side, and I would be surprised if that was the only way in which there were sort of these structural errors. And you have errors like that a few times, right? Okay, maybe that happens. You have errors like this both on the jobs numbers and on the oil numbers, and you have that happen over the course of years and not weeks. I think you have either a structural problem with how it's measured, and or you have a politicization of those measures and of those different government bureaus with instructions that aren't necessarily political, but are sort of dominated by the political either appointees or elected officials who are choosing to tilt the numbers in one way or another. So yeah, it's a great question, and it's sort of very complicated. And I think the very promising thing to me is that you have these amazing early indicators of growth in oil demand, the biggest being this tremendous increase in the price of gold and the price now of silver and some of the other precious metals and some of the industrial metals, like you mentioned. And that's been historically a really good early indicator for what's going to happen both with the price for oil as well as for demand. And when you think about it, with the demand for, let's say, corrugated cardboard, essentially, for boxes, because the economy is so weak right now, down, I think I saw it was at 2015 levels for demand for cardboard. When you're in that sort of environment, you can either choose to be extremely pessimistic about the current economic situation, or you can look at the history of these things, and most of the time when it gets this bad, generally by the time you're appreciating it and noticing it, by the time you're in this million job revision downward, whatever, on 900,000 job revision, you're already towards the bottom, and in many cases you're actually going to start seeing a reacceleration at some point. So maybe I'm too optimistic about the economy and eventual oil demand, but I actually think this is pretty promising, both for what we're seeing with gold and secondarily with other commodities, and then also with some of these very negative economic measures. Again, by the time you know you're in a recession, by the time you see it, often things are already reaccelerating or close to reaccelerating. And I don't think anyone is ready for a reacceleration of the US economy, of emerging markets, and the associated commodity demand, and particularly the associated oil demand.
Yeah. Thank you for sharing that. So just thinking about the pressure for interest rates to come down, and obviously that typically impacts the cost of capital for capital expenditure and such. And so just want to get your perspective there in terms of if interest rates come down, would we typically see like more activity in terms of investment and CapEx and such?
Yeah, so I think the Fed has sort of responded to all this stuff way wrong. So I think we shouldn't have had quite as low rates in the 2020 timeframe, 21 timeframe, and then the reaction to the inflation in 21 and 22 was raising rates really high, really fast, which I think was an overreaction, and it sort of suppressed investment, which perpetuated higher prices, right? More investment can lead to lower prices over time as there's investment in productive capacity to deliver those things. It's sort of like imposing rent control instead of reducing building regulations to allow more buildings so you can get lower rent. Houston, really easy to build apartments, and magically the rents here are not going crazy. Really hard to build apartments in New York City. And so if you look at the impact of interest rates on those, higher interest rates really hurt construction in Houston more than the rents do. And so it actually weirdly was very negative from an inflation perspective, medium term, to have raised the rates as much as were raised. And so, I think they're about to make another catastrophic mistake, which is to collapse rates and flood the market with liquidity again. It feels like we're on the precipice of that. And when all they needed to do was just sort of keep rates, maybe moderate them, have the rates go down a little in 2020 and 21, and then raise them a little in 22, and then maybe lower them a little now. So my expectation is the Fed will continue to make the mistakes that Milton Friedman talked about it making 40 years ago. It seems to be on track for that. So we're probably going to get much lower rates It'll probably be highly inflationary again. It feels like gold is front running that. It feels like silver is starting to price that in, and the dollar has been very, very weak too versus various foreign currencies, and that's all extremely positive for oil prices. Let's say 12 months out.
Yeah, definitely. All right, and so just transition into AI data centers and natural gas, and so. I was recently reading on Bison Insights, and you were speaking about how the demand is rising and such, and so for these data centers and such. And so could you speak to like the magnitude of that and what type of opportunity could be there for investors?
Yeah, so both with data center demand and with these LNG export facilities, there's booming activity in terms of construction, in terms of interest, both in terms of the development, and it looks like on the offtake side, there was a big data center company that very recently announced a very large customer order, and their stock almost doubled overnight, which was wild. It's a multi-billion-dollar company, and it trades like a penny stock. So huge demand sort of across the board. We chase this down to an extreme because it matters so much for the U.S. natural gas market. And for this newsletter, this Bison Insights newsletter, we started out by writing about some of these natural gas producers and services companies because we saw what this acceleration that gave us a variant, I think, more bullish view on gas than I think people have had. And so when we chase this down on the data center side, there's this narrative in the financial community that there's been an overbuild of data centers, and they'll point to the trailing financials of some of the data center hosting companies, but they're ignoring the enormous amount of current funded construction on these data centers, as well as the contracts associated with them that are supporting that construction and the finances around it. And so maybe it ends up being malinvestment. Let's say 5 years from now, we look back, there may be significant write-downs on some of these investments by some of the big tech companies and by the data center developers. But in the meantime, you're getting a huge amount of data centers built. It looks like there's actually probably upside from even where we published this thing a couple months ago, where I wrote about it, the demand maybe being an incremental 2 or 3 or 4 BCF a day. Maybe McKinsey was right for once, and it'll be 7 or 8 BCF a day by 2030 of incremental natural gas demand from these AI data centers. The AI part is really important because the big limitation that we found was, at least, again, this isn't my expertise, but finding folks that are experts at it, they were saying that most data centers can only handle about 5 or 6% of their capacity can be used for AI chips and for that whole sort of much more power intense and cooling intense build out. When you build special purpose ones, you can get 100% use, and that's part of why there's so little, there's so much undersupply and there's so much demand for these things, because there's so little availability right now, and demand, end user demand for these things is soaring. And so that's sort of the setup there. Similar on LNG, where with these modular LNG facilities, the folks at Venture Global and Cheniere have done a great job with building these enormous modular facilities. And the move from the sort of custom facilities that people used to build to these modular facilities is a step change. It's basically going from custom design stuff to the industrial revolution. So I think you're going to have way more of these things built. And as they build them faster, and maybe cheaper, hopefully cheaper, but faster and lower downtime, they're seeing more and more customers for them, both in terms of suppliers of gas and off-takers to go to send it to Europe or elsewhere. So the supply is rising, but our concern is that it may require a much higher price to rise enough to be able to meet all of the demand, both on the data center side and on the LNG export side.
Yeah, definitely. Sounds like there's going to be a lot of that. And I was just thinking about the capex cycles and understanding that when capital rolls into many of building out like these data centers and such, like that's where the investment opportunity lies, and you begin, and then you get like this overinvestment or malinvestment and such, and to where then it corrects itself and such. And so, would you say where do you think we're at in that? I mean, we're seeing like the companies that are building them out, or the big tech companies that are pledging certain billions of dollars to this particular industry. They're rising significantly, but we haven't seen like the price of natural gas and such like continues like rise significantly. And so just want to get your perspective there on where we're at in that cycle.
Yeah, I mean, I think it's a great question. Honestly, I don't know how much of this is going to be economic investment versus malinvestment. There are many folks that are way smarter than me that are choosing to spend tens of billions of dollars on these things. So, let's give them the benefit of the doubt and figure that, hey, at least the first ones of these that they're choosing to build and spend all this money on are probably economic. But, are the ones that would be built in 3 years or 5 years going to be economic? I don't know, maybe not. But what matters to me on this as an oil and gas investor, and then trying to figure out, hey, where is this boom not priced in? You have sort of the CapEx winners, the developers, the folks supplying the various parts that are used on the initial construction, the power connections, the chip makers. All of those are sort of the CapEx folks. And it's also helpful a little for oil demand in terms of the construction and assembly of these things. The real winners on the OPEC side are going to be the power providers and the energy providers to the folks that are generating the power. And it looks like natural gas will be the big winner there, at least in the medium term. And I think what's happened is everyone got excited about the AI theme, and they bid up some of the largest natural gas producers in the US and Canada. And then they were surprised when data centers that will be finished in 3 years or 2 years or 5 years weren't contributing to demand for natural gas right now. And so you have these companies at really high valuations that are big, with disappointed shareholders who are angry and concerned and frustrated. And then similar on the LNG side, there's a ton of LNG getting built or that will be built soon, but it's not on yet. And so, similar sort of frustration from two different essentially sets of shareholders that wanted exposure to these things, but I think got too excited too soon. And so the way I've navigated this is by finding companies that are smaller, that in my view had no value or even negative value priced into their stocks from this data center boom, from this LNG export boom. And that way, if they fizzle tomorrow, won't be great, but there's not much priced into the stocks. And then if it works out, then there's a huge amount of space just to catch up with some of these larger producers trading at much, much higher valuations, who then may also trade up to the extent that the smart folks deploying billions of dollars into them are right, and there's further upside.
Okay. And so with the projections for AI, I mean, some of these projections are going out to like 2030 with the data centers, the amount of power that needs to be generated and such. And so I've been thinking about, typically commodities are in a boom bust cycle and such, but it seems like with this AI narrative that it could potentially be a longer sustained bull market or something of that nature. And so I've just been kind of processing that. Do you have any perspective there?
Sure. So natural gas prices in 2007 were at about $7 per 1,000 cubic feet of gas. And right now, the spot price is around $3 per 1,000 cubic feet of gas. And there's been a lot of inflation in between 2007 and now. You look at the gold price, you look at however you want to measure it, a lot of inflation. There are very few things in the world other than electronics that are a lot cheaper right now than they were in 2007. So, I think the starting point might be getting natural gas. Maybe we don't even get back to the 2007 price, but we get close to it. There is a lot of natural gas that can get produced in the US very profitably at, let's say, $5 an MCF. So, even splitting the difference in between the current price and the price that we were at almost 2 decades ago would get you a long way there towards a bull market. And that price, I don't know that it's that contentious. Maybe it is. That price that's still a 30% or so discount from the 2007 price for natural gas seems pretty sustainable. And so maybe it's 450, maybe it's 5, but I see a lot of upside from here to there. And where that matters a lot in terms of your reference to sort of smaller cap companies or sort of marginal producers, I think there's sort of two kinds of companies that get called shitcos, to use your word, or the sort of common internet parlance.
Yeah.
There's the companies that are like frauds or scams or sort of management compensation schemes. And those are, I think, are uninvestable almost always. The stocks can go up or down on promotions, but those are sort of uninvestable. There's another set of companies that either on their current production are barely economic at sort of current commodity prices and require a higher commodity price to make a lot of money, or in some cases also they have land that can get developed, wells that can get drilled that would be highly economic at higher commodity prices. And so for either or both of those, in terms of the companies that require a little bit of a higher price, I think it matters a lot to understand how long that bull market might last, as well as what a sort of reasonable mid-cycle price might be. And so if the right number is, let's say, 450 an MCF, down from 7 in 2007, up a lot from 3 right now or 2 last year, that could mean a lot for a company with a break even at, let's say, 375 an MCF. And it means a lot less, I think, for a company with a break even at 2, because they're already making a lot of money. They're making a small amount incrementally more versus a company at, let's say, a 375 full cycle break even that at 450 or $5 suddenly is making a fortune instead of making almost nothing. So that's where it matters a lot. And that's where I think that distinction between the companies that are just sort of structurally a little higher cost but are well run and have a lot of opportunities to the upside versus companies that are sort of management compensation schemes or frauds or scams or whatever that I would find uninvestable.
Gotcha. Yeah, thanks for sharing that. So could you share with the audience a little more about Bison Interests and Bison Insights?
Sure. Yeah. So I've been running Bison Interests for the last little over a decade. We advise an investment fund. Again, none of this is an offer, recommendation, or solicitation for that, but that's my day job. And then what I found is that for better or for worse, there's a lot of folks that like listening to my views on oil and gas and my perspectives on oil and gas companies. And so I built a large social media following and have been on TV and on great podcasts like yours. And so it made sense to launch a product for these folks where I could offer something in sort of a more sort of organized manner. And so I started this Bison Insights, which is sort of fully separate. And in it, I share sort of more in-depth commodity research and then some thoughts on companies that I have exposure to with sort of full disclaimers. And we're also really careful about not trading ahead or whatever on that with sort of full appropriate compliance and so on. So we have this newsletter. It's like $20 a month, which we tried to price it as low as possible to just sort of have it be relevant for as many folks as possible, while also a high enough price to just support putting it together and having the research and all the other stuff done such that it would be a high quality product. So sort of a fun passion project, and so far so good. We have over 500 paid subscribers and on our way up from there. So it's a nice sort of early success. And honestly, it's so fun to find these off the run things, which I was buying anyway, and get to go talk about them and see people's reactions to them in a community and in a sort of organized way where it's all very constructive.
Yeah, and I think also, the oil industry, the energy industry is huge, and even thinking about, we talk to a lot of gold investors, CEOs of mining companies and such, and so you get some insights into the commodity itself and the markets and such. And so I was actually started listening to one of the interviews you did with someone who was very experienced in the shale aspect of the oil markets. And, I don't think I would have researched that out if I didn't see it there on Bison Insights. And so definitely I think that's helpful for investors that are trying to learn and engage with this sector.
Yeah, thank you. Yeah, no, exactly. I don't know if that executive or other similar folks are really sort of rushing to get onto like TV or onto sort of mainstream podcasts. But I think for this sort of audience, I think there's this nice way to sort of elicit some additional participants into, broader communication, but not yet sort of fully public communication like that. And so that was a fun one to do, and there are more coming. And it's sort of there's not really a lot financially for them to benefit from doing those. So again, it sort of helps to have this like community constructed. And that one also, that was supposed to be a 10-minute interview. And here I have this senior guy, super busy, tons of stuff to do, hiring more people, getting more clients, doing all this stuff, and sits down for, I think it was 50 minutes or something, where he was sharing his perspectives on things. So that was really fun. And it was great to be able to give people a lens. There's this real hotly contested topic of if shale has peaked or not. And there's really good arguments, I think, on both sides. And here you have someone that's helping advise the biggest companies and solve their toughest problems associated with more development, and his nuanced view. That was really fun to get to do and to share. And again, it's just not one of those things that ends up on YouTube or whatever. For the most part, I'll watch him go take it and stick it on YouTube. But for the most part, these are things that do sort of stay in behind closed doors, and it's nice to be able to open them a little and help people better understand these really complicated, nuanced questions and problems.
Yeah, for sure. Well, Josh, appreciate you coming back on. Look forward to having you back sometime. You all be sure to go check out Bison Insights, the newsletter. I'm a subscriber, and so I'm happy to learn a lot more from one of the GOATs in this industry. And so appreciate you, Josh, for coming on the show. And you all be sure to click the subscribe button so that we have your support. We're dropping content pretty consistently, so love to have your support. And thank you again, Josh.
Yeah, thanks again for having me. And yeah, people should sign up for this channel too. It's great, and I listen to it all the time. So thanks a lot.